Well, welcome to 2016, folks, and what a mess the markets are in. If you look at my screening tool at screener.nextbigtrade.com, if we filter to see market indexes, we can see that U.S. markets are all in stage 4 now. And what this means is when the general market is in stage 4, it means you should not be doing anything on the long side, because the market is essentially in a bear market now, and the longer term trend is lower. So any trades on the long side are essentially fighting the overall trend of the broader market. And it's really hard for individual stocks to fight this broader trend of the market, because as people lose money in different portions of their accounts, they sell positions kind of indiscriminately, and it puts downward pressure on the overall market. For example, a much loved stock, Apple, in 2008, I think went down from like 200 to under 80, so like over a 50% loss in that bear market. So really, bear markets are extremely dangerous, and nothing um, really escapes them. So if you go back to the markets page, you can really see how weak this market is. If you filter by stage 2 sectors as well, you see that the leading sectors right now are government bonds, REITs, utilities, and short index ETFs are now starting to move into stage 2. So this is, the markets page, and specifically when you filter on stage 2, this is really where you want to start figuring out where the strongest portions of the market are. And we can see that since we're in a bear market now, the strong portions of the market are all extremely defensive. Utilities, government bonds, and ETFs that are short the market. And one other thing to look at is if we go back to look at the indexes, we can see that only 18% of NASDAQ stocks are in stage 2, 17% of New York Stock Exchange, less than 17% of the Dow. So this market is extremely weak, and the breadth is very bad. And this is just the telltale sign of a bear market. Let's look at the S&P 500 and kind of discuss, where we're at in this bear market. And if you watch my video that I put out last fall, it was entitled "Tactics for Shorting the Stock Market." I talked about how the best times to enter short positions in the market are when the market is back above the 30-week moving average, and this starts to act as resistance when the market gets back above it, because the weight of the overall trend forces the market back down. So what happened last fall was that we saw that August massacre, but it took almost 4 months for the market to rebound and then plunge again, starting in earlier this month. So if you look at from late August all the way until late December, being on the bear side was really the wrong side of the market, and you were losing money, which is why bear markets are so tough to trade, is because you only had 2 weeks in August to win on the short side, and then you only had the last 3 weeks to start January to really make money on the short side, except for a little bit of money you could have made by positioning earlier back in November. But this was still hard to hold positions through until we finally got this plunge. I mean, essentially what happens is these plunges are fast and dramatic, and then you have a lot of rebound action in bear markets, which is why they're so hard to play. One thing that mitigates playing the indexes, though, is shorting individual stocks, and that's just a matter of targeting stocks that are rolling over, acting weak in extremely bearish sectors, and then shorting them essentially when they're above the 30-week moving average, or close to it, because that's the best time to short essentially. And what I talked about in that video as well is that a good time to short the market is when the percentage of stocks above the 50-day moving average is above 70 to 80%. And you can see that when I made that video, this the percentage was way down here, but I said I wouldn't be surprised to see it go over to 70 to 80% on the recoil rally off of the August low, and that's exactly what it did. So the ideal short entry you can see was, in late November to early December, which was right around here, and then you've seen a 200-point plunge in the S&P 500 since then. And now, the percentage of stocks is, um, you know, just hovering above 10%. So this is a lot more dangerous of a time to short the market, even though people on the bear side are probably getting overconfident and, everyone's starting to throw in the towel. But really, this down leg is now, over 200 points in the making. And if we go back to look at the bigger chart, I mean, essentially what's probably going to happen is we're going to break down below the support level, during this move lower that's still ongoing, and then probably recoil back up, retest this and this would establish itself as resistance, and then you can continue to move lower. So I don't know if that's for sure going to happen, but based on what typically happens when you hit a support level the third time, you're going to see this level break. But since we're still kind of later now in this bear down leg, I wouldn't expect it to go too much further before the market starts to rebound once again. So looking at ways to play this bear market, IEF, which is a kind of a medium term bond ETF, is actually breaking out into a new stage 2 advance here, and you can see the volume is increasing. You want to see, typically 2 times average volume, and you saw that last week in this ETF on the stage 2 breakout, as well as the relative strength is now it's been outperforming the S&P 500 since August of last year, and you don't have any overhead resistance in this ETF either. So this is a very good long side candidate, for this bear market. If you look at inverse ETFs, we can see that SDS is finally starting to, break out of the stage 1 basing action into a stage 2, and we can see we have some good volume on the upside too, over 2 times volume last week, which is good, and it's starting to outperform the S&P 500 obviously. And then the biotech short ETF is kind of doing the same thing. It's breaking out from a stage 1 base. We want to see the 30-week moving average hold on the pullback, and then that would be a good entry point once again. Once the all the nervousness calms down for the next bear down leg. Looking at the VIX right now in this latest down leg, we haven't seen the VIX spike up as much as it did in August, which makes me think that we probably seem to see more of a spike in the VIX before this bear down leg is over, which would coincide nicely with the breaking of support from the August downturn, and a new low being put in for the S&P 500. And just to close, let's look at some of the weaker markets, which really kind of foretold the bear market that was starting mid to late last year. You saw the transports break down below the 30-week moving average in the middle of last year, and then they really started establishing the 30-week moving average as resistance before they started their new bear leg lower. And they, the transports broke down again in mid to late December before the S&P 500 started breaking down. So the transports have really been leading this bear market since mid last year. And the second market that's been leading this bear market is the Russell 2000, the small caps. After topping out in the middle of last year, the small caps, broke down below 30-week, tested it once again as resistance, and then this was a good shorting point right here for the breakdown. And look at the Russell fell 20 points in a matter of 4 to 5 weeks. So that you can see the power and fury of a bear market, and how the market trends when they reverse catch overconfident bulls. at the end of bull markets. So going back to my stage analysis screening tool, the thing to keep paying attention to is the strength and health of the overall market. So um, as long as the major indexes are in stage 4, you just want to stay out of this market on the long side and really just be defensive until this bear market is over. You'll start to see the indexes move into stage 1 and then stage 2 when they resume or become healthy again, but we're a long way away from that right now. Thank you very much and have a good night.